Imagine two different companies. Company A has $1 million in cash sitting right there in its bank account, totally unencumbered.
Okay.
And Company B is $50 million in debt.
hmm
Now, if I asked you which company is safer, your instinct is probably screaming that Company A is the safe bet.
Right.
I mean, they have the cash.
Right. Yeah. It seems obvious.
Yeah, Company B looks like it's teetering on the edge of a cliff. But what if I told you that Company A is actually weeks away from total bankruptcy, and Company B is considered one of the safest, most stable investments on Wall Street?
It completely breaks how most of us are taught to think about money, you know?
Oh, absolutely.
We grow up learning that debt is bad, cash is good, and you should always play it safe. But when you scale that up to a multi-million-dollar business, well, those household rules completely flip.
And that is exactly the illusion we are going to shatter today. Welcome to the Deep Dive. Our mission for this conversation is to crack open the core machinery of business finance.
It's a big topic.
It is, yeah. We are using a comprehensive introduction to business finance pre-assessment as our baseline today. But we aren't just going to look at the answers. We are going to look at the why.
Yeah, the mechanics behind it all.
Exactly. The goal here is to demystify how businesses actually make money, how they measure if they're surviving,
Yeah.
and how CEOs make those terrifying million-dollar bets on the future.
Yeah.
And we're going to do it without the suffocating Wall Street jargon.
Which is great because, the most fascinating part of finance isn't really the math. I mean, the math is just a translation tool.
Right.
The real magic is the logic underneath it. Every single number on a balance sheet, every ratio, every interest rate, it all tells a deeply human story about human behavior.
Wow, yeah.
It's about fear, it's about ambition, and most importantly, it's about how we handle risk.
Okay, let's unpack this. We have to start at the absolute bedrock. If you strip away the stock tickers in the boardrooms, there is one fundamental principle that guides every single financial decision a business makes to optimize its resources. It's the risk-return trade-off.
Yeah, it is the steering column of the entire financial vehicle. The risk-return trade-off is the constant kind of agonizing balance between the desire for upside, making a profit, expanding the company, and the tolerance for downside.
Meaning losing the investment or, worst case, going totally bankrupt.
Exactly.
But wait, I mean, isn't the goal of a business just to make as much money as physically possible? Why wouldn't they just take the biggest risks all the time if it means the biggest reward?
Well, because humans run the businesses,
Yeah.
and human beings are fundamentally loss-averse.
Right.
Think about it in your own life. If I offer you a guaranteed $10 or a 50% chance to win $25, statistically, you should take the gamble.
Because the expected value is higher.
Yeah, but a massive percentage of people will just take the guaranteed $10. They want to protect what they have.
That makes sense.
And businesses are exactly the same, just with billions of dollars. If a CEO bets the entire company on a risky new product and fails, thousands of people lose their jobs. So they meticulously weigh exactly how much return they need to justify taking on a specific amount of risk.
So if risk return is the steering wheel, what's the actual engine? How does a company even get the gas to move in the first place? I mean, you have an idea for a business, you need cash to build the factory or hire the developers. You can't always just pull that out of your own checking account.
No, you need capital, and the process of fueling up is called capital raising. You basically have to go out into the world and convince other people to give you their money.
Okay, so let's role play this. I'm a CEO. I have a brilliant idea for a new tech gadget. I need $10 million right now to build the manufacturing plant. What is on my menu?
Well, there are a few options.
I know I can issue stock. That's the famous one, common stock. But what am I actually doing when I do that?
So when you issue common stock, you are literally selling off a permanent slice of your company. It is a share of ownership. And crucially, it comes with voting rights. You give me $1 million, I give you a percentage of the common stock. Now you get to vote proportional to your shares on who sits on the board of directors. You get a say in how my company is run.
Oh, man. Okay. My CEO ego hates that. I want the $10 million, but I absolutely do not want some random investor voting on my business decisions or trying to fire me.
Right.
Is there a way I can give them ownership without giving them the steering wheel?
Yes. You can issue preferred stock.
Preferred stock. That sounds like I'm giving them VIP treatment.
In a way you are, but you're also stripping them of their voice. Preferred stock is almost like a hybrid between a stock and a loan.
How so?
Well, if you buy my preferred stock, you are technically an owner, but you generally do not get those voting rights. You have no say in how I run the company.
Why would anyone buy that then, if they don't get a vote?
Because in exchange for giving up their vote, you give them a fixed dividend, a guaranteed set payout every single year, and they get paid that dividend before the common stockholders ever see a single dime of profit.
So it's safer.
It's a much safer position, yeah. If the company hits a rough patch, the preferred stockholders still get their fixed cut, while the common stockholders might get nothing.
Wow, okay.
It goes right back to our fundamental principle, right? The preferred stockholder takes less risk, so they accept a capped fixed return. The common stockholder takes maximum risk, so they get the voting rights and the unlimited potential for profit if the company explodes in value.
All right, but let's say I'm incredibly stubborn. I refuse to give up any ownership of my company, no common stock, no preferred stock. It's my baby. But I still need the $10 million for the factory. What do I do?
That is where bonds come in.
Okay.
From your perspective as the issuer, the entire purpose of a bond is to raise capital without diluting your ownership even 1%.
So it's just a loan.
Basically, a bond is literally just a legally binding IOU. You, the CEO, come to me, the investor. You say, loan me $10 million. I will keep 100% ownership of my company, but I promise to pay you back your $10 million in exactly 5 years, and I will pay you 5% interest every single year until then.
So I get the cash, I keep my company, but now I have this massive legal obligation hanging over my head.
Exactly. If you miss an interest payment on that bond, the bondholders can force your company into bankruptcy to get their money back.
Yikes.
That's the trade-off. You kept your equity, but you increased your risk of ruin.
Now, I always hear the term junk bonds in finance movies. It always involves like some guy in a tailored suit yelling into a phone, sweating profusely. It sounds almost illegal. What is a junk bond?
It's not illegal at all. Junk is just a highly dramatic industry term for a speculative bond.
Speculative meaning risky.
Exactly. Let's say your tech gadget company is brand new. You have no track record. If you ask me to loan you $10 million, I'm going to look at your business and say, you know, there is a very high chance you go bankrupt and never pay me back.
Fair enough.
So your bond is high risk. It is speculative. Therefore, to convince me to actually hand over my money, you can't just offer me 5% interest. You have to offer me 12% or 15% interest.
Oh, I see.
Yeah, a junk bond is simply a bond issued by a company with a higher risk of defaulting, which means they have to offer a massive reward to attract investors. High risk, high return.
Okay, we've covered stocks and bonds. But there's another instrument out there that always trips people up, and that's options. Specifically financial derivatives. How does an option actually work?
The absolute best way to understand an option is to take it out of the stock market entirely and put it into real estate.
Okay, let's do it.
Imagine you are walking down the street and you see a house you love. The owner wants $300,000 for it. You don't have $300,000 today, but you know you'll have it in 3 months. You also know this neighborhood is gentrifying fast, and in 3 months, that house might be worth $400,000.
I want to lock in that $300,000 price.
Right. So you go to the owner and say, I will give you $5,000 right now in cash. In exchange, you give me a contract that guarantees I have the right to buy this house for $300,000 anytime in the next 3 months.
Oh, wow.
That $5,000 is you buying an option.
Okay, so 3 months pass. A giant tech company announces they're building a headquarters next door. The house is suddenly appraised at $500,000.
You exercise your option, you hand the owner $300,000 as agreed in the contract, and you instantly own a $500,000 house. You win massive.
But what if the opposite happens? Like, what if a toxic waste dump is discovered under the backyard and the house's value plummets to $100,000?
This is the crucial part. An option gives you the right, but not the obligation to buy the asset.
Wait, really?
Yeah. If the house is now worthless, you just tear up the contract. You walk away. You are not obligated to buy it for $300,000.
So what did I lose?
Only the $5,000 deposit you paid for the contract in the first place.
Okay.
You captured downside risk at $5,000, but you had unlimited upside potential. That is exactly how stock options work. It's buying the right to make a transaction in the future at a locked-in price without being forced to do it if the market turns against you.
That makes perfect sense. All right, so we understand the instruments.
Oh.
We have our common stock, our preferred stock, our bonds, our options.
Mm-hmm.
But where is all this actually happening? If I'm that CEO, where do I take my freshly printed common stock to get my $10 million?
You take it to the primary market. And what's fascinating here is how often the general public completely misunderstands the mechanics of this.
How so?
Financial markets are divided by function into primary and secondary markets. The primary market is the only place where the company actually receives money.
Wait, really?
Yes. An initial public offering, an IPO, is the ultimate primary market activity. It is the very first time a company creates a new share of stock and sells it to the public. You, the investor, hand your cash directly to the company.
Okay.
The company hands you the brand new share. Capital has been raised.
So let me get this straight. When I pull out my phone, open my brokerage app, and buy 10 shares of Apple or Microsoft on the New York Stock Exchange,
Apple's not getting my money.
not a single cent of it.
Wow.
Trading stocks on the New York Stock Exchange or any major exchange you use daily is a secondary market activity. The secondary market is entirely made up of investors trading existing securities among themselves.
So I'm just buying that share of Apple from some guy in Ohio who wanted to sell his.
Exactly. Apple is completely out of the transaction. They already got their money years ago when they first issued that specific share on the primary market. You are just passing the paper back and forth with other investors.
That is wild to think about. It feels like you're investing in the company, but you're really just trading collectibles with other fans of the company. Pretty much.
If that's true, why does a CEO even care about their stock price on the secondary market? If Apple stock drops by 20% today, Apple, the corporation, didn't actually lose any cash from their bank account, right?
You didn't lose cash today, no. But the secondary market acts as the real-time scoreboard for the company's valuation.
Okay.
If a CEO wants to go back to the primary market tomorrow and issue new shares to raise money to build a new factory, they have to sell those new shares at whatever price the secondary market has decided the old shares are worth.
Oh, I see.
Yeah, if your stock price crashes in the secondary market, your ability to raise cheap capital in the primary market is destroyed. The two markets are locked in this constant, codependent dance.
Okay, so you've raised your capital, you went to the primary market, you issued your bonds and your stock, you have $10 million in the bank, you feel invincible. But you aren't operating in a vacuum. The money you just raised is immediately under attack by macro forces.
Oh, absolutely.
This brings us to the environment companies operate in. And let's start with who is actually holding the money. If a business needs to borrow capital, who is sitting across the table handing them the check?
For the vast majority of businesses, especially small to mid-sized ones, it's a depository institution.
Meaning banks and credit unions, places that accept deposits and provide loans. Now, how do they actually make their money?
Well, their primary source of revenue is interest income from those loans.
I always like to picture a depository institution as a giant toll booth on a bridge between two islands. On the left island, you have everyone with extra money, people putting their paychecks into savings accounts.
Okay, I like this.
And on the right island, you have people who desperately need money, businesses wanting to build factories, families wanting to buy houses. The bank builds the bridge between them. They take the deposits from the left island, pay those people a tiny bit of interest, say 1%, just to keep them happy. Then they walk that money across the bridge to the right island and loan it out to the businesses at 7% interest. The difference between what they pay out and what they charge that 6% gap is the toll they collect. That's their interest income.
It's a perfect analogy. They are the ultimate financial middlemen. But remember, building that bridge carries massive risks.
Because they could default.
Exactly. What if the business on the right island goes bankrupt and can't pay back the 7% loan? The bank still owes the person on the left island their original deposit plus the 1% interest.
Wow.
If too many businesses default, the bridge collapses. That's a bank failure. So the bank's entire existence is based on brilliantly calculating the risk of who they let cross that bridge.
And alongside these banks, you have these massive investment funds, mutual funds, pension funds. And these funds operate with a massive advantage because they benefit from economies of scale. How does that work in finance?
The economies of scale basically means things get cheaper the larger you get. For these funds, it comes down to making large-scale investments that massively reduce transaction costs.
Give me an example.
Let's say you, an individual listener, want to build a truly diversified portfolio. You want to buy one share of 500 different companies.
Okay.
If your brokerage charges you a small flat fee per trade, those 500 individual transaction fees are going to eat you alive. You'll lose a huge percentage of your capital just executing the trades.
That makes sense.
But a massive mutual fund pools millions of dollars from thousands of investors. When they buy into those 500 companies, they are buying blocks of 50,000 shares at a time. Their cost per transaction drops to practically zero on a percentage basis. They are structurally more efficient just by being huge.
But no matter how huge a fund is or how smart a bank is, everyone is subject to the weather of the economy. And the most dangerous weather pattern out there is inflation. How do businesses measure this?
They look at the Consumer Price Index, or the CPI.
And a rising CPI affects businesses directly by indicating increased costs for raw materials and labor. If I'm running that tech gadget factory and the CPI goes up 5%, what is actually happening on my factory floor?
It means the physical steel you buy to make the gadgets just got more expensive.
Right.
The electricity to run the machines just got more expensive, and your workers are looking at their own grocery bills going up, so they march into your office and demand a 5% raise just to break even on their lives. Your operating costs are exploding.
So my profit margins are getting crushed. What's my move?
You really only have two choices. You eat the cost, which shrinks your profits and makes your investors furious.
Okay.
Or you raise the price of your tech gadget on the consumer. But if you raise the price, maybe the consumer stops buying it altogether. A rising CPI forces businesses into incredibly painful decisions.
Which is exactly why the system needs referees to make sure companies don't cheat when things get hard. Financial regulators. Their role is to ensure fair and transparent markets.
Without regulators, the entire engine dies. Yeah. If a company's profits are shrinking because of inflation, the CEO might be tempted to lie on their financial statements to make the company look healthy.
Right. To keep investors happy.
Exactly. And if the regulators aren't there to catch that lie, investors buy the stock based on fake numbers. When the truth inevitably comes out, the stock goes to zero, the investors lose everything, and trust in the system vanishes. And if trust vanishes, no one will ever buy a stock or a bond in the primary market again. Capital raising freezes, the economy stops.
Speaking of the temptation to lie, there is this fascinating concept in business finance that bridges the gap between math and human psychology. It's called the agency problem.
Oh, this is a classic.
And to fight it, companies have to rely on ethical considerations to align managers' goals with shareholders' interests.
This is perhaps the oldest problem in the history of business. Let's do a role play.
Okay.
You own a wildly successful bakery. You are the shareholder. But you want to retire to a beach, so you hire me to be the day-to-day manager of the bakery. I am your agent.
Okay, my goal as the owner is long-term sustainable profit.
Right.
I want this bakery to grow steadily for the next 20 years so my retirement is funded.
Right. But what are my goals as the manager? I don't own the place. Maybe I want an easier schedule. Maybe I want to hire all my unqualified friends to work with me.
Oh.
Or worse, maybe my contract says I get a massive $100,000 cash bonus if the bakery's revenue doubles this year.
Oh, I see where this is going.
If I only care about my bonus, I might take insane, reckless risks. I might borrow a ton of money to open 3 new locations instantly, slashing prices to drive up raw revenue to hit my bonus target.
Wow.
I get my $100,000 check on December 31st, and then I quit. In January, you come back from the beach to find out the 3 new locations are hemorrhaging cash, the debt is crushing the business, and your bakery is bankrupt.
Our incentives were completely misaligned. You acted in your own self-interest at the expense of mine.
Precisely. That is the agency problem. And the solution isn't just asking people nicely to be good. Ethical frameworks and governance structures are the tools to fix this.
How do you fix me, your rogue manager?
You change my compensation. Instead of a cash bonus based on 1 year of revenue, you pay me in stock options that I can't touch for 5 years.
Brilliant.
Suddenly, if I bankrupt the company in year 2, my own payout goes to zero. You have structurally forced me to care about the long-term health of the bakery. Ethics in finance isn't just about feeling warm and fuzzy. It is a structural mechanism to keep everyone pulling the same rope.
And we see that same structural logic applied to how companies interact with the world at large. We always hear the acronyms ESG and CSR, ESG being environmental, social, and governance criteria, CSR being corporate social responsibility.
Right.
It sounds like charity work,
Yeah.
like supporting education and healthcare initiatives or reducing carbon footprints. But from a purely financial perspective, why does Wall Street actually care about this?
Because it is fundamentally risk management. Let's say you are evaluating 2 oil companies. Company A ignores all environmental regulations, treats its workers terribly, and has a board of directors made up of the CEO's cousins.
Oh, wait.
Company B strictly monitors its pipelines for leaks, pays a living wage, and has an independent board. 10 years ago, people might have said Company A is better because they are saving money on compliance. But today, investors realize Company A is a ticking time bomb. One massive oil spill because they ignored maintenance, one massive worker strike, or one corruption scandal, and the stock price will implode.
Wow, yeah.
Integrating ESG criteria into investment decisions promotes sustainable practices because it helps investors avoid catastrophic, unpriced risks.
Okay, so we've covered the foundation. We know how businesses raise capital. We know the markets they play in. And we know the treacherous environment of inflation, agency problems, and macro risks they navigate. But here is the critical question. If you're standing on the outside looking in, how do you actually know if a business is surviving that environment?
You need an X-ray machine. And in business finance, that X-ray machine is financial ratios.
The purpose of financial ratios, particularly for investors, is to evaluate a company's potential for return on investment. They provide a standardized basis for performance evaluation and allow for benchmarking. That word standardized feels like the key to this whole thing.
It is the only way to make sense of the numbers. Imagine you are comparing a local family-owned coffee shop to Starbucks.
Right.
The local shop makes $100,000 in profit. Starbucks makes billions in profit. If you just look at the raw dollars, you can't compare them. But what if the local shop only spent $100,000 in assets to generate their $100,000 profit?
That's 100% return.
Exactly. What if Starbucks had to spend $30 billion to make $3 billion? That's a 10% return.
Suddenly, the local coffee shop is vastly more efficient at using its resources.
Exactly. Ratios strip away the raw size of the numbers and turn them into proportions. They allow you to benchmark the local shop directly against a global behemoth on an apples-to-apples basis.
Okay, let's turn the X-ray machine on. There are three main categories of ratios we need to look at. The first one is liquidity. The core question of liquidity is simply, can you survive tomorrow? Can you pay the bills that are sitting on your desk right now? The foundational metric here is the current ratio, which evaluates short-term liquidity.
It's a simple formula. Take all of your current assets, cash in the bank, inventory on the shelves, money people owe you, and divide it by your current liabilities, the bills you have to pay in the next 12 months.
Okay.
If the resulting number is high, say a 2 or a 3, it means you have twice as many assets as you have bills. You have a strong cushion. You are highly liquid.
But the X-ray can be deceptive. Let's say I'm looking at a company and their current ratio is fantastic. It's a 3. But then I look at their cash ratio, which just looks at pure hard cash against those same bills, and it's terrible. It's a 0.2. What is going on and how do they fix it?
If your current ratio is high, but your cash ratio is low, it means all your wealth is tied up in things that aren't cash. Usually it's tied up in accounts receivable.
Meaning I provided a service to a client, I sent them an invoice, but they haven't written me the check yet.
Exactly. They owe you money. So on paper, in your current assets, you look rich, but you can't pay your electric bill with an invoice you sent to a client.
Right. They want actual money.
The electric company wants cash. So to improve liquidity in this scenario, the business must speed up the collection of its receivables. You have to get on the phone, call those clients, and demand they pay their invoices faster. You have to convert those paper IOUs into actual cash in the bank.
Which leads us to the most brutal test of survival, the quick ratio. Some people call this the acid test. A high quick ratio during an economic downturn shows a company can cover obligations without selling inventory. Why are we stripping inventory out of the equation?
Because in a true economic crash, your inventory might become completely worthless. Imagine you are a high-end luxury car dealership. The economy tanks. People are losing their jobs. Nobody is coming onto your lot to buy an $80,000 sports car.
So all those cars sitting on my lot, which I count as assets, are basically just giant metal bricks.
Exactly. I can't sell them fast enough to pay my rent this month. The quick ratio takes your current assets and completely removes the inventory from the math.
Wow.
It asks a terrifying question. If you sell absolutely zero product today, can you still survive the week based purely on your cash and the money you are owed?
We have a perfect real-world case study for this. Imagine an aircraft manufacturer. It's the end of the year, and they want to pay their employees year-end bonuses in exactly 30 days. They are trying to figure out which financial metric they should look at to guarantee they have the cash to do it. The answer is the quick ratio.
Why?
Because building an airplane takes years. Their inventory is massively expensive, but it is incredibly illiquid. You can't just quickly sell half of an unfinished jet fuselage on Craigslist to make payroll by Friday.
Yeah, good luck with that. Their inventory is essentially frozen wealth. To know if they can write those bonus checks in 30 days, they have to completely ignore their inventory and look only at their highly liquid assets.
Which gives me a massive realization. If I am analyzing a company, the absolute widest disparity between their current ratio and their quick ratio is going to be found in a firm with a massive amount of inventory.
100%. If you look at a consulting firm, they just sell advice. They have zero physical inventory. So their current ratio and their quick ratio will be almost exactly the same number.
Right.
But if you look at a giant grocery store chain, they have billions of dollars of food sitting on shelves. The disparity between their current ratio, which includes the food, and their quick ratio, which excludes it, will be massive.
Okay, so the quick ratio tells us the company isn't going to go bankrupt this week. They survived. But surviving isn't thriving. Just because you have cash doesn't mean you aren't wasting it. How do we measure waste?
We shift from liquidity ratios to activity ratios, or as they are sometimes called, efficiency ratios.
The core question here is, are you wasting your resources? Let's go back to those clients who owe us money. Accounts receivable. We have two metrics here, the average collection period and the accounts receivable turnover rate. If my average collection period is high, say 90 days, that indicates a painfully slow conversion of receivables to cash.
It means you do the work, send the bill, and the client essentially takes a 3-month interest-free loan from you before they finally pay up. Your cash flow is suffocating.
What I want is a high accounts receivable turnover rate.
Yes. Turnover means how many times a year you cycle through your receivables. A high turnover rate indicates frequent, rapid collection. You bill them, they pay you in 15 days, you put the cash in the bank, you do it again. You are operating efficiently.
What about physical things? The X-ray machine looks at something called total asset turnover, or TAT. If a company has a low total asset turnover, it means they aren't generating enough sales relative to the assets they own. The solution is to eliminate inefficient or unproductive assets.
Let's visualize this. Your company owns a giant $100 million manufacturing plant, but you only run one shift a day.
Okay.
The plant sits dark and empty for 16 hours every day. Your total asset turnover ratio will be terrible because you have this massive asset that isn't generating maximum revenue.
So how do I fix it?
You either run 3 shifts a day to pump up the sales volume, or if you don't have the demand for that, you sell the giant plant, buy a smaller one, and eliminate that inefficient asset. You lean out your operation to drive the ratio up.
This connects perfectly to inventory. I love this next case study because anyone who has ever worked retail will instantly understand the math behind it. Imagine a newly hired manager at a sporting goods store. He runs the X-ray on his store and notices that his inventory turnover ratio is 3. He wants to increase it to 5. How does he do it? The textbook answer is he needs to feature products for sports and activities that are currently in season.
Let's walk through the physical reality of what an inventory turnover of 3 means. It means that, on average, the store completely empties its shelves and restocks them 3 times a year.
Right.
Essentially, an item sits on the shelf for 4 months before someone buys it.
Which means it's tying up my capital and gathering dust.
Exactly. If it's July and the manager has a massive display of snowboards at the front of the store, nobody is buying them. That inventory is stagnant. The turnover ratio is dropping.
Makes sense.
To drive it up to 5, meaning the shelves clear out every 2.5 months, he has to physically move the snowboards to the back warehouse and put bathing suits and camping gear at the front door.
Oh, wow.
By pushing seasonal items, he guarantees faster sales. The product flies off the shelves, he reorders, it flies off again. Retailers don't just put seasonal displays up to look festive, they are meticulously managing their inventory turnover ratio to balance consumer demand against the heavy cost of holding stagnant products.
Which entirely explains the sheer chaos of Q4 in retail. Think about a massive big box retailer. Between November 1st and December 31st, they experienced the wildest swing in their ratios of the entire year. First, their inventory skyrockets as they pile the shelves to the ceiling with toys and electronics in October.
Right.
And then, over those 60 days, the inventory violently depletes and their revenue shoots up to the moon.
It is the ultimate test of their efficiency ratios. If they ordered too much inventory, it sits there in January and their turnover ratio tanks. If they order too little, they miss out on revenue.
Okay, so we've confirmed the company has enough cash to survive, and we've confirmed they aren't wasting their physical resources. But there is a final, ultimate category of ratios on the X-ray machine: leverage and profitability. The question here is, are you actually making money, and whose money are you using to make it?
Let's tackle profitability first, because just having high revenue doesn't mean you're actually making a profit.
We have two key metrics here: ROA, return on assets, and ROE, return on equity. ROA suggests how effectively management is using the company's assets to generate earnings. ROE identifies the profitability relative to the equity, meaning the actual money the owners put into the business.
I like to separate them like this. ROA asks, how good is the CEO at using the tools we bought them to build a profitable house?
Okay, I like that.
And ROE asks, when the house is sold, how much cash are the actual owners walking away with in their pockets?
Let's run a comparison case study. You are an investor evaluating two local dry cleaning businesses. Chain A is small. They have two locations, but they operate at a 35% profit margin.
Right.
Chain B is much bigger. They have 10 locations, and they operate at a 47% profit margin. As an investor, you conclude that Chain B is more operationally efficient. Now, my initial instinct is that Chain B is better just because it's bigger. 10 locations is more than 2. But that's not what the ratio is telling us, is it?
Not at all. Often when companies get bigger, they get less efficient, they get bloated with middle management. But Chain B is defying that. Out of every single dollar a customer hands them over the counter, they keep 47 cents as pure profit, while Chain A only keeps 35 cents.
Interesting.
Chain B has figured something out. Maybe because they have 10 locations, they get a massive bulk discount on dry cleaning chemicals. Maybe they share one centralized delivery truck network instead of each store having its own. Whatever they are doing, they are squeezing more profit out of every dollar of revenue. They are definitively more efficient.
All right, let's talk about the scariest word in finance: leverage, which is really just a sophisticated word for debt. If I look at a company's X-ray, how do I know if their debt is going to kill them?
You look at two specific ratios. The first is the debt to assets ratio. This simply tells you how much of the company's stuff is actually owned by the bank. If a company has $1 million in assets and a debt to assets ratio of 60%, it means the bank effectively owns $600,000 of their stuff, and the equity holders own the remaining $400,000.
But just knowing the total amount of debt doesn't tell me if they can handle the payments. I might have a massive mortgage on my house, but if my salary is huge, I'm perfectly safe.
Exactly. That is why you must look at the second ratio, the times interest earned ratio, or TIE. This is the crucial one. It signifies the company's ability to cover its debt payments out of its operating income.
Think about your own mortgage right now as you listen to this. If your monthly take-home pay is $5,000 and the interest on your mortgage is $1,000 a month, your TIE ratio is 5.
Right.
Your income can cover your interest payment 5 times over. You can sleep soundly at night. A business is doing that exact same math.
And this is where so many people fundamentally misunderstand corporate finance. Debt is not inherently evil. It is a tool. If your TIE ratio proves you can easily handle the monthly payments, debt is actually a superpower.
Let's prove that with a puzzle. Let's say I am looking at a PC manufacturer. They have steady, predictable sales. They want to expand, and they need $5 million to do it. The board of directors wants to find the absolute least expensive way to finance this $5 million.
Okay, let's see.
I look at their X-ray. Their current debt-to-assets ratio is 30%. The rest of their industry average is 50%, so they have less debt than their rivals. I look at their TIE ratio, their ability to pay interest. It's a massive 60. The industry average is only 54.
Wow.
Now, if I am an amateur looking at this, my instinct is to say they're doing great because they have low debt, don't ruin it, issue common stock to raise the $5 million so you don't take on the burden of a loan. Am I wrong?
You are totally mathematically wrong. The board wants the least expensive money, and here is a universal law of corporate finance. Debt is almost always cheaper than equity.
Why?
Think about what equity is. If you issue common stock to get that $5 million, you are selling off a permanent, forever slice of your company's future profits.
Oh, wow.
Every year, until the end of time, a percentage of your success leaves the building to pay those new shareholders. It is incredibly expensive in the long run. But a loan just costs you a fixed low interest rate. Once you pay the $5 million back, the bank goes away. You keep all your future profits.
So because their ratios, the 30% debt to assets and the incredibly strong 60 TIE ratio, prove they can safely handle the risk of a loan, debt is undeniably the correct, cheapest choice.
Exactly. They have massive untapped borrowing capacity. Using equity here would be an incredibly expensive mistake.
I have another scenario that shows debt acting as a savior. Imagine a custom cabinet maker. They're struggling. The cost of labor has skyrocketed in their city, and it is dragging down their profit margins and their return on equity.
Okay.
The finance team recommends a radical move. Take out a massive loan take on heavy debt to purchase advanced robotic equipment that automates the tasks currently done by expensive human labor.
That is surgical precision in finance. They have a bleeding wound, uncontrollable labor costs. They have a tourniquet, robotic automation. But the tourniquet costs millions of dollars they don't have.
So they borrow it.
If they take on debt, they acquire the machines. The machines slash their monthly operating expenses because they don't have to pay high wages anymore. That massive drop in expenses instantly restores their profit margins and drives their return on equity through the roof.
That makes total sense.
The new automated efficiency generates more than enough extra cash to easily pay the monthly interest on the loan. They use debt to save the business.
Okay, we have successfully x-rayed the present condition of the business. We know how they survive today. But investing isn't really about the present, is it? It's entirely about the future.
It is. The X-ray tells you where you are standing. But to figure out where you are going, you have to undergo a cognitive leap. You have to understand that time literally changes the weight of money.
This brings us to the time value of money. The foundational concept that a dollar today is not worth the same as a dollar tomorrow. And the core mechanism driving this phenomenon is opportunity cost.
Opportunity cost is the ghost of the choice you didn't make. It is the reality that money can only be in one place at a time.
The pre-assessment uses a great simple example. A home builder uses all of the firm's available cash to pay massive annual bonuses to his employees in December. Everyone is happy. But in January, his key lumber supplier offers him a massive 5% cash discount if he pays for his entire year's worth of wood up front.
Ah, I see.
The home builder can't do it because he drained his cash on the bonuses. The opportunity cost to the home builder is the inability to take that cash discount.
And that lost 5% discount is a real measurable financial loss to the business. He chose to put the money in box A, which was the bonuses, which means box B, the discount evaporated.
Right.
The money you have right now has immense power because it gives you options. The moment you spend it or the moment you are forced to wait to receive it, you lose that power.
So let's stretch time out and see what happens to money over decades. Let's talk about retirement and compounding. The text states that 401k plans are uniquely used for retirement savings, and it sets up a scenario. An employee makes a one-time deposit of $5,000 into their 401k. To get the greatest retirement savings, they should choose to leave it for 30 years, earning 8%.
Okay.
Now, this seems obvious, but it highlights the two levers of the time value of money, time, and the interest rate.
You always want to maximize both. 30 years at 8% fundamentally crushes 25 years at 6%, or even 25 years at 8%. Why? Because of compounding.
The snowball effect, yeah.
Yeah, in year one, your $5,000 earns interest. In year two, you earn interest on your $5,000, and you earn interest on the interest you made in year one. It snowballs. The longer you let it roll down the hill, the time lever, and the steeper the hill is the interest rate lever, the more massive the snowball gets.
But financial planners don't just roll the snowball forward. The assessment says the present value of an annuity is vital for retirement planning because it determines how much needs to be saved today to meet future financial goals. They are rolling the snowball backward up the hill.
Exactly. When you or I think about retirement, we usually think forward. If I save $100 a month, what will I have in 30 years? But a financial planner thinks in reverse. They ask you, how much money do you want to pull out of the bank every month when you retire?
Let's say you save $5,000 a month.
That future stream of income is called an annuity.
Let's define that term because it's key. The text defines an example of an annuity as making credit card payments of equal amounts at 21% APR to retire an outstanding balance. So an annuity is just a series of equal payments made at regular intervals.
Right. Your car payment is an annuity. Your rent is an annuity. And in retirement, the $5,000 you pay yourself every month is an annuity.
Okay, I followed.
So the financial planner takes that future annuity of $5,000 a month, and they reverse engineer the math. They discount it backward through time to calculate its present value. They say, in order to generate that specific future flow, the math dictates you must save exactly $432 a month starting today. They use the future to dictate the present.
There's a mathematical multiplier that helps them do this. We have a case study with a company called Whole Pine Inc. They are paying a marketing consultant $15,000 annually for 6 years with an interest rate of 5%. The factors that influence the future value interest factor for an annuity or the FE-IFA are the number of payments, the interest rate, and the payment amount. And crucially, a higher interest rate increases the FE-IFA.
Don't let the acronym intimidate you. The FEIFA is literally just a multiplier on a lookup table.
Right.
It tells you what a steady stream of payments will be worth at the end of the road. If the interest rate goes up, if the hill gets steeper, the money compounds faster. Therefore, the multiplier increases, and your final future value is a bigger number.
Okay, let's put this time-traveling math into a high-stakes scenario. You're the CEO of a restaurant chain. A massive beverage supplier desperately wants their soda in your restaurants. They offer you 2 different contract bonuses to sign with them.
All right, what are the options?
Contract A, they will hand you $2 million, but you have to wait 3 years to get it. Contract B, they will hand you $1 million, and you only have to wait 2 years to get it.
Okay.
The source says that to compare these 2 contracts fairly, you absolutely must calculate the present value of both. But my human brain is screaming at me, $2 million is twice as big as $1 million. Just take the $2 million. Why is my human brain wrong?
Because your human brain is ignoring the opportunity cost of time. Let's walk the dollars backward physically. You have $1 million in year 2. What if you took that million in year 2, invested it brilliantly in expanding your restaurant, and in that 1 year between year 2 and year 3, you generated a 150% return?
No.
Suddenly, by year 3, your $1 million has turned into $2.5 million. So the $1 million in year 2 is actually heavier than the $2 million in year 3.
Exactly. But you can't just guess. You have to prove it mathematically. You take the $2 million that is sitting 3 years in the future, and you imagine inflation and opportunity cost acting like a headwind.
Okay.
Let's say that headwind is 10%. You push the $2 million backward through time against that 10% headwind for 1 year, shrinking it. You push it back a second year, shrinking it again. You push it back a third year to land on today. You do the exact same process for the $1 million, pushing it back 2 years.
And only when both of those heavily shrunken numbers are sitting on today's starting line, their present value, can I actually compare them apples to apples.
Precisely. The raw future numbers are a mirage.
Right.
Present value is the only truth, which is the perfect transition to our final phase. We know how to X-ray the present health of a business. We know how to calculate the true weight of money across time. Now, how do CEOs combine all of this to make those massive company-altering bets, like building a billion-dollar factory or expanding into Asia?
They use a formal process called capital budgeting.
According to the text, projects like expanding to a new market require a capital budgeting decision.
Right.
It's the process of evaluating major long-term investments where you spend massive amounts of capital today hoping to get a return over many years.
Right.
But before a CEO can evaluate if a project is good enough, they have to know where the baseline is. They have to know how high the hurdle is that the project needs to jump over. That hurdle is called the cost of capital, and it is typically measured as a percentage return.
Think of the cost of capital as the minimum cover charge just to keep the lights on. It costs money to raise money. You have to pay interest on your bonds. You have to pay dividends on your stock. If you blend all those costs together, let's say it costs your company an average of 8% a year just to access capital. That 8% is your hurdle rate. If you spend millions building a new factory and that factory only generates a 6% return, you are bleeding money. You are destroying the value of your company. The project must clear the 8% hurdle.
We have a specific case here. Imagine a construction firm that is entirely financed by loans and bonds. They have 0 stock, 0 equity investors. To evaluate new investments, their specific cost of capital is simply equal to their after-tax cost of debt.
Because they don't have any shareholders demanding a return, their math is easy. Their only hurdle is what the bank charges them in interest, minus the tax deductions they get for paying that interest. That final percentage is their hurdle rate.
But what if a company does have equity? What if they have stock? The source note that if a company's stock has a high beta, it increases their cost of equity. Why? Because a high beta indicates higher risk, which requires higher returns. Can you ground that for me?
Beta is simply a measurement of volatility. Think of the stock market as a theme park. An index fund is the merry-go-round. It's safe, it's slow, nobody gets hurt.
No.
A company with a beta of 1 moves exactly with the merry-go-round. But a company with a high beta, say a 2 or a 3, that stock is a terrifying, looping roller coaster.
And investors hate uncertainty. They get seasick on roller coasters.
Exactly. If you want me to ride your terrifying roller coaster of a stock, You cannot charge me a premium ticket price. You actually have to promise me a massive prize at the end of the ride just to get me to strap in.
Oh, that makes sense.
Because the company must offer this massive potential return to attract investors to their risky stock, their internal cost of getting that equity capital goes way up. The roller coaster pushes the hurdle rate higher.
So companies have choices on how to fund these projects, and each choice has a different cost. The assessment asks some fundamental why questions about this. Why use retained earnings to fund an expansion? Because it's a preference to use internal funds instead of seeking external options.
Retained earnings is just the profit you've already banked from last year. It is the absolute cheapest money you have. There are no bankers to pay, no new shareholders to answer to. You just use your own savings.
Why might a company be hesitant to raise new debt capital? Because taking on additional debt could increase default risk and raise its cost of capital, making future borrowing more expensive.
We talked about how debt is cheaper than equity, but there is a limit. The more mortgages you take out on your house, the riskier you look to the next bank. Eventually, they either say no or they charge you an extortionate interest rate.
And here's a tricky one about stock. A renewable energy company is acquiring a competitor. The question asks, which factor would make the issue of additional common stock the best financing option? The correct answer is, existing owners want to retain their same level of ownership.
Okay, this is an interesting one.
Now wait, if you issue millions of new shares of stock to the public to buy this competitor, don't the existing owners get diluted? Doesn't their slice of the pie get smaller?
It's a great catch, and it highlights a specific mechanism in finance. Yes, if you sell new shares to random people, the original owners get diluted. However, in major acquisitions, companies often do what's called a rights issue.
What's that?
They offer the brand new stock directly to the existing shareholders first. They say, we need cash. If you buy these new shares proportional to what you already own, your percentage of ownership stays exactly the same, and we get the cash we need for the acquisition.
Oh, clever.
It allows the owners to maintain the status quo without forcing the company to take on dangerous, high-interest debt that could bankrupt them all.
Okay, so the CEO knows their hurdle rate. They know where the money is coming from. Now they sit at their desk, they look at 3 different proposals for a new factory, and they have to choose. They use 3 main tools to attack this: the payback method, NPV, and IRR. Let's start with the one everyone instantly understands, but the math completely hates: the payback method.
The payback method is the most basic human instinct in finance. It simply asks, if I spend $10 million today, how many years will it take for this factory to hand me $10 million back?
If the answer is 3 years, you do it.
Right, but the source explicitly states a massive limitation of the payback method. It completely ignores cash flows after the initial investment is recovered.
Walk me through how that causes a disaster.
Let's say Project A pays back your $10 million in 3 years, but then it breaks down and generates absolutely $0 for the rest of eternity. Project B takes 4 years to pay back your $10 million, so it looks worse under the payback method.
Okay.
But in year 5, Project B generates $50 million in pure profit.
The payback method is completely blind to year 5. It would tell me to pick Project A.
Exactly. It doesn't care about total wealth creation. It only cares about speed of recovery. It must be used alongside smarter tools.
Which brings us to the undisputed heavyweight champion of corporate finance, NPV, net present value. The textbook states that the advantage of NPV is that it accounts for the time value of money, providing a more accurate analysis. It assesses cash inflows by calculating the present value of each annual inflow for the appropriate number of periods at the discount rate and adding them together.
This is the restaurant beverage contract scenario on massive corporate steroids. You want to build a factory. You map out every single dollar you predict that factory will generate for the next 10 years. Year 1, year 2, all the way to year 10.
Got it.
Then you use your hurdle rate, your cost of capital, as a headwind. You push year 10's money backward 10 years. You push year 9's money back 9 years. You mathematically shrink every single future cash flow until they are all sitting in a pile on today's starting line.
Then you add up that pile of present-day money.
Yes. And the final critical step. You subtract the initial cost of building the factory today. If the final number is positive, it means the project creates wealth above and beyond your hurdle rate. You do it.
Let's look at a clean example. A real estate development company calculates an NPV of $500,000 for a proposed residential project. The verdict: the project should be undertaken because it is expected to generate more value than costs.
Simple as that. The math says it clears the hurdle and creates $500,000 in pure present-day wealth.
But let's look at a deceptive one. A company evaluates a project requiring a $100,000 initial investment. It will return $40,000 in year 1, $50,000 in year 2, and $30,000 in year 3. The company's cost of capital is 10%.
Okay, let's look at the math.
Now, if I use my flawed human brain, I add up the returns. 40 plus 50 plus 30 equals 120,000. I spent 100,000, I'm getting back 120,000. I made a $20,000 profit. The payback method says do it.
Right.
But the text says the calculated NPV is negative $3,900. The verdict is that the project is not profitable and must be rejected. How did a $20,000 profit turn into a loss?
Because the $20,000 profit is an illusion created by ignoring time. When you take that $30,000 in year 3 and you push it backward against a 10% headwind for 3 years, it shrinks drastically.
Wow.
When you push the year 2 money back, it shrinks. When you add up the truly shrunken present-day value of all those cash flows, they don't add up to $120,000. They only add up to $96,100.
And I spent $100,000 to get them.
Exactly. You spent $100,000 today to buy $96,100 worth of present-day value. You destroyed $3,900 of wealth. NPV just saved you from making a terrible mistake that the payback method would have cheered for.
Okay, the final tool in the CEO's drawer, IRR, the internal rate of return. Why might a business prefer using IRR over NPV? The source says it's because IRR provides a single percentage, which makes comparing dissimilar investments easier.
Think about human communication. If you are the CFO and you run into the CEO in the elevator and you say, I analyzed the new factory in Germany. The NTV is $42,000. The CEO doesn't really know if that's good or bad.
Right. Did we spend $1 million to make $42,000? Did we spend $1 billion?
Exactly. The raw dollar amount lacks context. But if you say, the IRR for the factory is 14%, and the CEO knows the company's hurdle rate is 10%, they instantly know the project is a winner. It's a simple percentage that intuitively communicates the power of the return.
Like our case study with a firm investing in new delivery vehicles. The project has a required rate of return, a hurdle rate of 10%. The calculated IRR is 12%. Should they accept? Yes, because the IRR of 12% exceeds the required return of 10%. It's a pass-fail test.
Precisely. If the IRR is higher than the cost of capital, you jump.
But what happens when the tools fight each other, when they give you conflicting advice? This is my favorite scenario in the entire pre-assessment, the clash.
Oh, this is the ultimate test.
A small business is evaluating 2 completely different projects. Project A requires $250,000 and has an IRR of 8%. Project B requires $400,000 and has an NPV of $220,000 when discounted at 10%.
Okay.
The firm's cost of capital, their absolute baseline hurdle is 9%. The business has enough cash in the bank to do both projects. What should they do?
This is the ultimate final exam for everything we've talked about today.
The correct answer from the text is invest in Project B only.
Let's break down exactly why. They have the money for both, so why not do both? Let's look at Project A. The IRR is 8%. It sounds like a decent return, but what is the firm's cost of capital?
It's 9%. That's what it costs them just to access the money.
Right, so Project A fails the most fundamental test of finance. It costs them 9% to fund a project that only returns 8%. It destroys 1% of value every single year.
Oh, wow.
It does not matter that they have the cash sitting in the bank right now. Investing it at 8% when your benchmark is 9% is a guaranteed loss of economic value. You must reject A.
And Project B.
Project B is evaluated using NPV. It has a positive NPV of $220,000 when discounted at 10%. Notice that they use a 10% discount rate, which is even stricter than their 9% cost of capital.
Yeah.
And even against that brutal 10% headwind, it still produced $220,000 of pure present-day wealth creation. It is an absolute home run. You reject A, you accept B.
It is so deeply mathematical and rational. Which brings me to a question. If NPV and IRR are mathematically perfect, why do humans still love the payback method so much? Why do we constantly default to asking, when do I get my money back?
Because humans are deeply psychologically wired to hate uncertainty. The payback method doesn't answer a financial question. It answers an emotional one.
Wow.
It answers, when am I safe again? When do I get my chips back off the table? We crave the psychological comfort of getting our initial investment back as fast as possible.
That makes total sense.
NPV, on the other hand, requires you to trust a mathematical model that is predicting cash flows 7, 8, 10 years from now. It requires you to trust the math over your own fear of the unknown. It's scary. But as we've proven today, trusting the math is the only way to uncover the truth.
Wow. We have covered an incredible amount of ground today. We started with the basic tension of the risk-return trade-off.
Oh.
We built a capital engine with stocks and bonds. We navigated the treacherous environment of banks, inflation, and ethical agency problems.
There's a lot to take in.
It is. We learned how to X-ray the health of a business using liquidity, efficiency, and profitability ratios. We manipulated the very fabric of time by calculating opportunity costs and present value. And finally, we sat in the CEO's chair and used capital budgeting tools to make executive decisions.
It really is an entirely different language once you start putting the pieces together. The numbers stop being math, and they start being a story about human decisions.
They really do. And as we wrap up, I want to leave you, the listener, with a final reflection drawn right out of that tension we just talked about between the payback method and net present value.
Yeah, think about this.
Think about the X-ray analogy we started this whole deep dive with. We wanted a clean, binary answer. Broken or not broken? Safe or unsafe? But business and life is murky. How often in your own life do you make decisions based purely on the payback method?
Oh, that's a great question.
How often do you choose an action or a job or a relationship based entirely on how fast you can get an immediate, safe, recognizable return? How often do you do that while completely ignoring the massive, compounding long-term value that might come years later, which an NPV mindset would reveal?
It's a powerful shift in perspective.
It really is. Business finance isn't just a textbook to help corporations maximize profit. It might actually be a blueprint for making better, more courageous, long-term decisions in your own life. Thank you for joining us on this deep dive. You are now armed with the true mechanics of how business gets done. We'll see you next time.